Tesla tanking today, down double digits after CEO Elon Musk announced the electric vehicle maker will cut 7% of its workforce. Phil LeBeau's live in Chicago with more on this story. Hey, Phil.
And Melissa, when you look at what's going on with Tesla, it's pretty simple. This is a company that is in the process of eliminating 7% of its workforce. That comes out to about 3,100 jobs, and the reason is they need to lower the cost of the Model 3. In an email to employees, Elon Musk said, while we have made great progress, our products are still too expensive for most people. How expensive is the Model 3? Well, they talked about someday selling it for $35,000. The reality is that most Model 3s on average are selling for between $50,000 and $55,000. Now, Elon Musk would like to raise the volume and bring that average transaction price down somewhere in that $40,000 range, maybe $35,000 to $40,000. But in order to do that, they've got to be a lot more efficient and they've got to lower their costs, which is why when you take a look at shares of Tesla, keep in mind that he also said today that they will be likely posting a profit, a tiny profit, in the fourth quarter. It'll be lower than in the third quarter, but it is, in his opinion, going to be a profit. However, going forward, guys, we're now in that area of lumpy deliveries. Not entirely sure about how much demand is there, especially as they try to lower the price point at which they're going to sell the Model 3.
Phil, you know, last year, I believe it was in June or over the summer, they also fired some staff and then they hired back a lot of people. And so when you take a look at the staffing levels over the past, let's say, 9 months or so, is it actually almost the same? So this 7% reduction in the workforce actually looks to be the same number of workers.
Well, he said today that they increased their hiring by 30% in the last year.
Yeah.
So it doesn't look like they're getting rid of everybody that they brought on. But, Melissa, people are misconstruing the fact that they added all of these people, that they ramped up their production of the Model 3, and they met their goals with the idea that they can continue at that level of staffing. You just can't have that many people building these vehicles. It's not cost efficient over the long term, and that's why they need to become much, much more efficient and lower their costs.
Okay. Phil, thanks. Phil LeBeau in Chicago for us. So is the stock too risky to own? And I don't even know why I'm asking this question to you, Tim, because I think I know the answer. Because you're going to say no.
So let me surprise you.
You cannot own it.
Well, I'm going to point out that first, if this was Ford or GM doing this, we'd actually be impressed. We'd be rewarding the company, and we kind of did that with GM. But of course, they're not. And this is the whole point with Tesla. The risks around Tesla are not around their battery. They're not around the technology. They're not around, even at this point, even the CEO. They are about ramping up. And to me, that's the big risk, because Tesla, operational efficiency and execution to really grow this thing into a mass market, this is a mass market car, has been held in question. And it does make you question whether what they did last quarter is sustainable. And also, that that tax cut, I think, is a lot more important to Tesla than people thought, and losing that's a big deal. The subsidy, excuse me, sorry.
I think that the problem, whatever the reality is in terms of the cash burn, we'll find that out when Tesla reports earnings, is that when you hear about staff reductions in order to make something more efficient or more profitable, whatever, you immediately think about what their position is. And you think about them building a factory in Shanghai, and you think about them continuing to ramp up production and meeting targets and wanting to remain profitable, and you think maybe they got to do a capital raise. I mean, that's back. Not that it's gone away, but it's definitely back in the forefront.
A couple months ago, we said they sort of took the capital raise out of the equation when they talked about how they're going to be cash flow positive, right? I thought, listen, I do think there's a chance for a capital raise as well. And the fact that the stock has rallied off them historically, I don't think it does this time. Stock has been in this 275-ish to 375 range. It's vacillated there a number of times over the last couple of years, and it feels as though you're going to revisit that 275 level and then give it another shot there on the long side.
I mean, that's just it. It's just it's a gambling chip. Actually, the exact high is like 385. The bottom is 250. It's done that 6 times. So when you drop from 385 to 250, you drop 35%. You got to climb 50% back to make it to the high, and it's done that 6 times. Nobody's winning in this, bearable, and it has nothing to do with whether he's tweeting or smoking or whether he's cutting or not cutting or he has a tent or he doesn't have a tent.
What the stock does.
It's just what the stock does. It's one of the highest beta Untradeable.
Done nothing
things
in
there
5
is.
years.
I think you guys have to remember that they're going to lose on a GAAP basis $1 billion this year. Okay, like so, you know, I mean, it's not like things are getting that much better. They sold 7,000 more cars quarter over quarter in Q4. You know, so to me, this thing is challenged. This is one recession away from being in a very tough spot. And don't forget, SpaceX also cut employees last week too.